Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of corporate filings. And I've got a spicy one for you today. This filing is an amendment which usually means they missed something important the first time. We're diving into Hartford Creative Group Incorporated's latest report, and let me tell you there are some late-breaking revelations here. So the main reason for this filing an amendment, meaning they had to go back and fix what they originally submitted, is because they discovered some related party relationships that were not properly disclosed. This all started on the 26th of November when Miss Erin Songwang acquired a big chunk of the company, 39%. This made her a major shareholder, and suddenly two other companies tied to her Shanghai Xiaohong assets, Limited or Xiaohong and its subsidiary Shanghai Oversea Chinese Culture, Media Limited or Shaj Oversea became related parties. Then on the 2nd of December, another company, Shanghai Kongluzai Brands Management Limited, or KLZ, also became a related party because it was bought by S.A. Xiaohong. This is like a corporate game of musical chairs, and they just now telling us who the new players are. Let S jump into the numbers. On the balance sheet for the 30th of April of this year, they show current assets. Cash and cash equivalents have dropped significantly from over $300,000 to under $50,000. Accounts receivable also took a hit. Now look here at current loan receivable related party. This number jumped quite a bit from around $138,000 to over $660,000. This directly relates to that new related party KLZ. We will get more into this later. On the liabilities side, related party loan and payables are quite high at over $4 million. This also reflects those new relationships and how they re-intertwined financially with these other entities. Now for the income statement, the previous report for the 9-month period ending the 30th of April of last year showed some revenue from related parties. But this updated report for the same period in 2025 shows zero revenue from related parties. This is interesting given all the new related party dealings. Overall revenue has seen a massive jump for the 9 months ended the 30th of April this year. Total revenue was over $1.2 million compared to just over $179,000 in the same period last year. That is a huge, almost 570% increase. This growth is primarily from their advertising placement services. This revenue surge has turned their operating situation around dramatically. Last year, they had an operating loss of almost $5,000 for the 9-month period. This year, they have a positive operating income of over $553,000. That is a massive swing, and that positive operating income has trickled all the way down for the 9 months ended. The 30th of April last year income before taxes was just over $8,000. This year, it is nearly $600,000. With that increased profitability comes income tax expense. They paid over $234,000 in income taxes this year for the 9-month period, whereas last year they paid nothing. This is a good problem to have. And the big number, the net income for the 9 months ended the 30th of April 2024, they reported a net income of just over $8,000. For the same period this year, it's $362,000, a nearly 4,250% increase. On the surface, this looks fantastic. Even though the numbers have improved, earnings per share are still very low at 1 cent for the period. This is likely due to the large number of outstanding shares. Diving into the statement of changes in stockholders' equity, we see the accumulated deficit, which is like the company's total past losses, is still quite large, though it has shrunk. It was over $5.9 million last July and is now under $5.5 million. The accumulated other comprehensive income has grown quite a bit, showing positive unrealized gains from things like currency translation. Looking at the cash flow statement for the 9 months ended the 30th of April this year, operating activities provided about $24,000. This is a small increase from last year. Investing activities used over $527,000, which is primarily due to that new related party loan receivable we saw earlier. Financing activities provided over $239,000, mainly from related party advances. The advance to contractor number went down significantly from over $2.4 million to about $912,000. This is probably a good sign, as it means they are using less cash upfront for services. On the flip side, contract liabilities also dropped substantially from over $1.3 million to about $252,000. This means they have less money from customers that they owe services for. Accounts payable also decreased dramatically from over $1.3 million to $425,000. This suggests they are paying their suppliers faster or have fewer outstanding bills. Remember that significant jump in the related party loan receivable. While the cash flow statement shows over $665,000 used in investing activities for this, they essentially loaned out that much money to a related company during this period. Now let's dig into Note 4, related party payable. This section clarifies the nature of these relationships. The company has paid interest on loans from Hartford Hotel Investment Incorporated. They also received advances from a relative of a major shareholder, and this balance was converted to a non-interest bearing advance. It states that on the 10th of December of last year, the outstanding loan balance was converted to this advance. This whole section highlights just how interconnected the company S finances are with these individuals and entities. Looking at subsequent events, they've continued to expand their media business by establishing a new subsidiary in Nanjing, China, called Nanjing Haoyipeng Information Technology Limited, or NJHY. This is part of their strategy to grow their social media advertising business. Let's talk about the business and how it is performing. The report shows for the 3 months ended the 30th of April this year, revenue was $354,000, a jump of 204% from the same period last year. This growth is attributed to effective market expansion and a growing customer base. Operating costs also went up by 97% to nearly $170,000. They explain this is due to investments in scaling operations, including hiring more people and expanding infrastructure. As a result, operating income is up a massive 509% to over $184,000. They also incurred an income tax expense of over $95,000 this period compared to none last year, which is a direct result of their increased profitability. And net income grew 69% to over $90,000. Okay, now let's look at the longer 9-month period. Revenue for the 9 months ended the 30th of April this year was over $1.2 million, a staggering 570% increase from last year. They attribute this again to market expansion and a growing customer base. Operating costs and expenses increased by a significant 251% to $646,000. This investment in growth is key. The company flipped from an operating loss of $4,800 last year to an operating income of over $553,000 this year, a huge turnaround. And finally, net income for the 9-month period is up over 4,250% to $362,000. This shows some real momentum. However, it is not all smooth sailing. The company still has a significant working capital deficit of over $3.1 million. That means they owe more in the short term than they have readily available. They also have a large accumulated deficit of over $5.5 million, meaning they still have a lot of past losses to overcome. They plan to seek additional financing through debt or equity, and are even looking to uplist their stock from the OTC market to NASDAQ, which could help them raise capital. Now, about those material weaknesses in internal controls. The company admits they did not implement sufficient working procedures and maintain proper accounting support for their new business operations at the subsidiary level. This is a big red flag. It means they might not have a solid grasp on their own financials, especially with all these new and complex related party dealings. So what is my take on all this? Hartford Creative Group Inc., or HFUS, is definitely in a growth phase. The revenue numbers are impressive and they've managed to turn a profit after struggling last year. Their shift into media and marketing seems to be paying off. However, the large working capital deficit and the acknowledged material weaknesses in internal controls are serious concerns. It looks like they are growing very fast, but perhaps not as quickly as their financial reporting can keep up. The constant stream of related party transactions also adds complexity and a layer of risk which they are still trying to fully disclose. The plan to uplist to NASDAQ is a bold move that could provide much needed funding, but also brings greater scrutiny. The success of this company will depend on their ability to manage this rapid growth, while strengthening their internal controls and financial reporting. Can they harness this momentum and become a solid, profitable business, or will the rapid expansion and reporting issues be their undoing? The jury is still out, but it is definitely a company to watch. Alright, that is our deep dive into Hartford Creative Group's latest amended filing. What do you think about their rapid growth and the lingering financial reporting issues? Let me know your thoughts in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more corporate insights. And don't forget to join our Discord community, links in the description for even more discussion. Thanks for watching, and I'll see you in the next one.